everybody, and welcome to Leading Entrepreneurs of the World. I'm Stelios Hatzakis, CEO of One Business World. Leading Entrepreneurs of the World features entrepreneurs, founders, and business leaders presenting on cutting-edge topics and the latest industry developments. Today, we're very pleased to welcome global entrepreneur Akram El Youssi, joining us from the Financial Center in Dubai. Akram is the founder and CEO of InstaVal, a digital platform made to help founders and investors close equity deals efficiently and fairly. Akram has held senior roles in investment banking and private equity and brings more than 20 years of financial domain expertise to InstaVal, leading the company's vision as a platform to promote equity investments in startups and small and medium-sized enterprises. Akram, it is great to have you here with us today to hear more about venture funding in emerging economies. Welcome to Leading Entrepreneurs of the World.
Thank you, Stelios. Thank you very much. Yes, like you said, we are live here in Dubai from the GIC FinTech Hype in GIFC itself. So, I'm obviously an investment and finance professional, and I'm an entrepreneur. And this is, and the reason why I'm an entrepreneur is basically thanks and because of this subject that we are going to kind of go through together for the next 30 minutes or 1 hour or so. It's about cracking the code for venture funding in globally and in emerging economies specifically, because this is where the problem lies the most, and cracking the code for funding entrepreneurs, but also at the same time, that means also optimal capital allocation and deployment for investors, which is another problem. So, yeah, it's a very noisy world, and it's got even stranger and noisier with lately. So yeah, I think I would like to end this presentation lately with this statement, but maybe it is right also to introduce it. I mean, the evolution and history of mankind, as we've as ourselves sapiens have been witnessing it, is we are at the age of abundance, and we are at the age of abundance of capital, entrepreneurship, and technology, and this makes it a very, very noisy and actually full of opportunities, but full of noise, which makes the urgency call for leveraging technology and automation and data science and artificial intelligence to kind of reconcile all these parts of this puzzle, I would say. So yeah, I would like to also, yeah, I'll share that as well. So so yeah, I mean, I like this saying that says, the best early stage venture capital investments appear obvious in retrospect. However, very few of them are actually obvious when you make them, and that stems from a fundamental. That's obviously when you retrospective learning is obviously natural, but it also stems from asymmetry in information and and how you digest information over time, and this is where the problem lies effectively in the venture funding space. It's basically the lack of information and how that information being the information to consume by investors, or information in terms of knowledge to disclose by entrepreneurs. So yes, this saying is very true, and I believe from my perspective it is linked to the asymmetry of information in the private market. So this is a very much known bias by professionals. So yeah, I mean, I would like to go through the global venture funding landscape. I mean, it remains quite strong, and the world is going more so into capital rather than credit. I mean, capital is taking over, and yeah, and the banking and the lending model is another subject maybe, but yeah, capital is taking over, and because of that, that age of abundance where we are, so a lot of you could set up a venture cost effectively, lean, etc. So yeah, I mean, opportunities and wealth creation does not demand much, and hence, investors, which usually make their IRR basically at the entry or within or at the exit. Now at the entry, on the upstream of the value chain, I mean, there are a lot of opportunities because wealth creation is becoming accessible and cost effective. So obviously, venture funding, yes, this is taking over little by little, and is doing pretty much fine. I mean, as you see here in the numbers, I mean, global venture funding growth is hitting $300 billion. That's just an enormous. I mean, it's basically 40 billion in January 2021. I mean, just a couple of months ago. That's an all-time high. Dry powder, to be deployed capital is about $200 billion. So that's, yeah, and this is also the problem is where to actually deploy it, and this is the information asymmetry problem as well, and the distribution channels as well. We'll get to that problem a bit later, but still doing great. I mean, the trends are great. So from 10,000 deals in volumetry 10 years ago, it's 3x in less than 10 years. Chances are it's 4x now. So that's quite substantial. New Silicon Valley is worldwide. That's a very true statement. I mean, today every single major city worldwide is building their own startup and technology ecosystems. I mean, the world is delving into that. I mean, there no longer Silicon Valley monopoly, although there is an edge in Silicon Valley itself as historically, but yeah, I mean, that's the history of the moving comparative and competitive advantages, and from Adam Smith, The Wealth of Nations. So that's quite natural that other nations and other cities and other technology ecosystems are born and doing just fine. So. And this is what gives unicorn boom. I mean, you can measure that with how many unicorns were in 2013 and today. So that's quite of a substantial. So here we have 7x in 5 years, which is crazy. So, and that's that. I mean, the technology leaps and the faster and the deeper technology gets into to the world infrastructure and ecosystem, the higher the valuations. I can't see any hinder to this trend. I mean, and as soon as as computers, as APIs communicate to each other, as data is consumed, as AI, as machine learning is there, so it will keep on feeding and as platform network effects. I mean, as they are consumed and they will be factored in the valuation. So and a unicorn is a valuation. It's very much correlated. I mean, that's how we define actually a unicorn. So yeah, globally it's doing fine. But there is a but. So but venture capital in emerging economies remains quite elusive. So yeah, I mean, this is quite with 200 million businesses in cash difficulties. So there is a capital crunch. Yeah, there is a funding gap of 5.3 trillions in emerging economies. Although we're doing fine on the global scale, but there is still a funding gap. Yeah, we have 2 over 5 startups that have 3 months or fewer of capital runway. Yeah, which is quite short. Last year, 2 over 3 startups with term sheets had their funding rounds cancelled, which is natural. I mean, investors, got turned off with COVID-19. It was a very uncertain and strange time, so they'd rather cancel or delay, which is a natural behavior. So, and that impacted the survival and the liquidity curve of startups, and there was a lot of mortality last year. So, and maybe this year, I mean, with the lagging factor. So that's that in terms of a fundamental trait in emerging economies. What is also a fundamental trait in emerging economies is the level of investment readiness, and that stems from awareness, education as well, and ecosystem sophistication. So it's a triangular formula actually. So yeah, entrepreneurs are not aware of the VC funding world. I mean, not being financially savvy or aware. So this is one thing, and we can't expect all entrepreneurs or to have investment and financial education. I mean, the entrepreneurs are there to solve problems and not to build financial models in Excel. This is it's fair, and what is maybe less fair is I believe, and we'll get to that, how to solve that. I mean, there is little understanding of what investors are looking for and do not know how to convincingly articulate their investment proposal. I mean, this is a communication soft skill deficit. So that's that. And in terms of investor engagement and deal structuring issues, I mean, they don't know where to go to find the right investor. So who's Mr. Right or Mrs. Right for female-led investors? It's an emotional decision to surrender ownership and control. If it's an equity deal, so I believe there will be more equity friendly or equity free models that will emerge. I mean, I know that few around the globe are emerging, and I think it's great because I have a few on top of my mind, but they are doing, they have cracked the problem and they are leveraging AI to deliver term sheets in instantly. I mean, in under 24 hours, which is with zero equity. So capital as a service is I think is an opportunity for the new era we are entering in actually. So capital is basically will be a commodity, but also its consumption is a service as well. So that's that. On top of that, emotional decision on ownership and control. So if we put that aside, and if we still on the equity as we speak now, I mean, what is the rule worldwide is entrepreneurs, investors have frequent disagreements over valuation. And that's a perception problem and an asymmetry of information and perception problem. So I mean, I think we are building up the case for the solution as we go, but these are the kind of the facts that are all over the place. I mean, in emerging economies, in the venture funding space of in emerging economies. Whereas, yeah, on the investor side, so let's see a bit on the other side of the table. I mean, investors have a slow, inefficient, costly, and often biased investment process. You can't blame them for such, because again, to the risk of being redundant, yes, there is information asymmetry, and that's why they rely on kind of, yeah. So deal flow quality and quantity deficit. For half of VCs, personal networks is the most valuable resource to source and evaluate opportunities. So, you know, I rely on you know, personal trust. So I buy the trust of or opinion of others on the founder capacity, on KYCs, etc., etc. So that's that. Another fact is, yeah, in 75% of venture-backed startups eventually fail, unfortunately, and that's a trait of deal flow quality and quantity deficit. Once it's so on the production or on the value chain side of investors, so it's a manual and long due diligence process. Yeah, yeah, 1,000 to 3,000 proposals per year. So it's about up to 12 per day. So that makes it a lot. Yeah, it's kind of elaborate and kind of challenging to process. It's time consuming, manual formatting. Example, I mean, financial models, memos, etc. And you have the principal agent problem, which is, yeah, this is why it is biased kind of investment process. Untapped data and uninformed decisions again. So 2/3 of VCs do not currently leverage data science to inform venture investment decisions. Okay. And only 20% of VCs believe data is the most important factor when evaluating investment. So we've been sourcing all these in footnotes. So yeah, it's PitchBook, EM Broker, and MetaBeta, and also in the other side and everywhere we have footnotes to. Yeah. So what is the solution of all this? You know, we have problems that are here and there. So yeah, I believe to this. I mean, we need that first. The solution, it's always, I believe, in education and the power of education and the intellectual capital. So this is I believe in that, and actually intellectual capital is the asset that does not obey to diminishing law of returns. It's the only asset actually that defies this law. Every single asset under the sun is subscribes to this law and obeys to this law, which is so financial literacy training actually is so to advise entrepreneurs, so and coach them basically, so educate them on what's out there. So this is one thing. So perhaps have in curriculums you know, some kind of if we have today, you know, coding camps for kids as a soft skill, so maybe tomorrow we should have some kind of, you know, soft skills, how to pitch and how to build a pitch deck and how to kind of I think the really when where education should go is to kind of give equip and empower yeah, tomorrow's entrepreneurs with you know, the investment readiness scorecard. They will always rely, and I'm a big promoter and fan of that, on their emotional intelligence, which is unique, and this is what we commonly know as gut feeling. But they will use you know, the rational side of their brain as well, and there is absolutely no harm to that, and actually that's a good safety net, good, you know, mechanical process to do, and if both, you know, their EI and that investment readiness scorecard matches is ticked, then yeah, I mean, it's the right venture to go to. It's the right venture to invest in with friends. It's the right venture to invest in as an investor. So I think education, and even this is, I mean, this is valid also for angel investors. I mean, there are a lot of people who are, you know, they're sitting up on you know, on loads of money, but they are not necessarily have been trained to be professional investors. So it's not helping neither side of the table. So yeah, so angel investors could also learn from that. I mean, professional investors, I'm sure they're all set, but yeah, individual investors, and I think this is the trend will go towards that. I mean, it's we're going to, yeah, I mean, the that could be part of another presentation or another topic, but yeah, I mean, atomizing the cap table and bringing liquidity to that cap table on a retail basis. I think this is where we're all heading, instead of speaking about, you know, big chunks of assets to buy or sell. But I think it's yeah, and you know, valuation technology and cap table technology is getting there to lead us and to drive this trend. So fine. So we on the code, on the financial literacy side. So we have that. Yeah. Digitalize the investment readiness process. So yeah, I mean, cancel redundancy, like was said. So automate the investability scoring through machine learning and data science. The grown businesses to meet investor requirements faster and cost effectively, and coach entrepreneurs to deliver a killer investor pitch. So that's what I've been kind of saying earlier. And help, and this is a very important part. So automate the investors matching. I think this is as much as the you know, the first two are more entrepreneur dependent, I would say, or this part is entrepreneur independent, because it's the role of a machine to point or to direct who are the best investors in town or not, that are fit, that are ready to deliver you know, a term sheet in under X amount of time. So and that's the role of a machine. I believe it's no longer the role of the entrepreneur to lead his business or her business you know, stalling and do this job. It's a good learning. I'm sure it is, but there is a limit to that learning. You know, beyond a certain point, it's no longer bringing value to the entrepreneur to kind of keep looking for you know, in the dark. So I think it's the role of a machine to do this, and it will, as we will see, it will serve both sides of the table again. So yeah, I think matching and Tinder or LinkedIn or whatever for investment this is a very old problem that has been solved for other verticals, and there is no there is no exception for the venture funding space not to have it, and not to have it you know, at large scale. I mean, there is an opportunity to build a utility for that. I mean, a public utility even which solves for the trust factor. So on the front that I ask my neighbor to tell me about whether founder Lambda is a good or bad investment. So I think that's the role also of the technology can solve that. I mean, it's a public utility, and built on blockchain, and trust is there. So is managed inside that. I mean, it's and again, matching is a very Tinder or LinkedIn or the like. I mean, it's very much appropriate, and yeah, I don't think it's the role of the entrepreneur to do that. So okay, and that's that on this front. Yeah, an investor to buy into new models to support efficient process from sourcing to due diligence. Again, I think it's their role more to drive this trend, and we can talk for not for hours, but for some time, because it's I mean, it is favoring few people to leave it as it is, to say it bluntly like this, because they are charging a premium and alpha on that. But the general trend and the global trend will finally, I mean, and will ultimately beat that kind of oligopoly setup. And I believe investors have the mission and the duty to drive that. First, they are more well off than the other side. So they are the supply side, if we are talking capital. So yeah, that's that. And second, it's their duty, because I think in terms of even yeah, I mean, the education median here and here, I think here it's quite there, and I think they have the mission to drive that. So why it is not, I don't, yeah, I think we can debate that, but there is an opportunity to build that. I mean, to build the infrastructure network, something like what banks have done with Swift, actually. So it's a different topic, but not very much far, actually. So anyway, but there are ones who are there, who are pushing to drive and bring new models, so and to automate and broaden deal flow acquisition. So yeah, data science to scan opportunity and automatically build an initial up-to-date deal flow, to leverage public large data sets, automate the due diligence in standardization, leverage AI to analyze the funding history, etc. Structured data to cross-check market comparables. So all that, analyst as a service, it's there, and I think it serves the the purpose of letting them do whatever they do best, is basically spot the right deal based on their emotional intelligence, so that's one, because there are limits to automation and to AI, and second, build value within the life of the investment, and lastly, yeah, find bank and exit. So that's their job, actually. So they are compensated for these three events and 3 milestones. The rest is just redundancy, I mean, and it's the role of, like I said, machines and automation and to do it. So yeah. Yeah, and lastly, I mean, prioritize data and opportunities of sourcing. Definitely, I mean, yeah, same idea, same yeah. So analytics to drive fact-based decision making to reduce false positives and false negatives. Again, it's reinforcing the same idea. Yeah, I mean, net, we are the bottom line, the finish line is that we are the verge and the opportunity to reinvent the growth funding industry. So this is an opportunity. I mean, where we stand today, it's an opportunity to it's one of the last uh, verticals or spaces that have resisted disruption, because it's a quite complicated process that lives off the combination of the process is complex and has many events. It's quite, yeah. So but this is, it can be automated, but is there an incentive to automate it? Is there, so this is what we need to kind of so there, if there is a will, there is a way. So I think few have the will, and hence there are few ways. But I think the more we push and we kind of, you know, make people aware of the opportunity to you know build you know ecosystems that are tech driven and leave, so that we cancel redundancy and distribute and deploy capital efficiently. I think it's for the benefit of all. I mean, there are only winners here. So yeah, I mean, so to help founder get funded at scale. So this is exactly what we're saying. I mean, and exactly, I mean, failures in emerging ecosystems without deep talent, experience, and capital will leave deep scars. So that's the downside if we don't do that. Yeah, there is a leverage effect, definitely. I mean, if we do it. So yeah, I mean, an ecosystem that is 3x larger creates about 5x more economic value. And not doing it, basically, it leaves that at a toll of you know, losing 50% of the economic value of the ecosystem. So rebuilding economic communities with a stronger focus on inclusion. So that's, yeah, that's the willingness component. So every crisis creates opportunities, and this crisis is no different. So I believe, yes, it's this COVID-19 is also an incentive to it has, yeah, it has pushed us all to rethink much. So yes, and this is one of the things that yeah, that is on the table, actually. And the rest is just facts. You know, over half of Fortune 500 companies are during contraction. Over 50 were created in the Great Recession. So yeah, I mean, just to reinforce the fact that, yeah, we are at a turning point at the and yeah, we ought all to leverage and capitalize on it. So so yeah, that's that. This is just a bit about us. I mean, yeah, like I said earlier, so it's a digital investment readiness platform. This is what our mission is, to promote equity investment in startups, scale-ups, and SMEs, incorporating DIFC. This has many valuations we've computed so far, over you know, X number of countries. Yeah, so that's it. Thank you very much, Stelios, for having me. Any questions?
Akram, wonderful insights on the global venture funding landscape and what an amazing work you and your team are doing with at Insaval, offering great value to startups and companies out there throughout the investment readiness process. And as you said, cracking the code for funding is always quite challenging for entrepreneurs, and especially in a noisy, quote unquote, complex world. We see an abundance of opportunities, but at the same time, there is a funding, there's a lot going on out there, and one might get lost. It's also exciting to see how many startup ecosystems are emerging all around the world, supporting the development and growth of young companies led by visionary entrepreneurs. And also quite interesting what you said about the funding gap that can be seen in emerging economies. Another quite interesting point that you said and you mentioned is, and it was great to hear about, was the automation and digitization of the investment readiness process, both for the entrepreneur, the potential investee company, and for the investor, and how you and your team, of course, at InstaVal officially enable this automated process for companies out there. So, understanding that that valuation is a combination of facts, data, assumptions, and the estimating the value could be a challenging task, especially in the case of startups and generally companies that may not be able to identify clearly defined tangible metrics to base an assessed value on the company on. So in this readiness process for an investment, what would you say are key steps of this journey for a company to get funded? You spoke about financial literacy training and understanding the capital raising options. You spoke about digitizing the readiness process and automating investor matching. At the same time, during this process, what functions, management, finance, accounting, investor relations, should entrepreneurs make sure that they have well set up to ensure that they will be seen as a good funding opportunity to the right investor? Would you be able to expand a little bit more on?
Sure. So what your question? I mean, it's so you want. Yeah, I mean, are you? Is your question about investment readiness itself, or any? What is the peripheral?
During this journey. During this journey of getting ready to be an investment opportunity, to be seen as an investment opportunity, would you say that we have the digitization of the process, the automation of the process, but for high growth, with all the noise, as you said, out there, and for high growth companies out there, what should be in place to enable for a smoother automated process to happen and a better matching with the right investor?
Yeah,
advisors, the different functions that should be well functioning within the company.
The entrepreneur's company. Yeah. Look, first, one thing we need to agree about here is that automation will not make a lousy company great, or a great company in any worse off. So that's one thing. I mean, fundamentally, there is no debate here. Now, the investment readiness, I mean, ourselves at InstaVal, we are learning, I mean, on the go, and it's very fascinating because the process, now we are introducing a curation filter. So at first, we had a blast and a spree. So everyone is signing up, and then, but everyone, I mean, it's not everyone is ripe to get, the data room ready, etc. It's so they need deal support, they need help, either it could be us who would do this help, or via service providers, or maybe, but to some certain extent the investor, but let's not get there. So and hence to solve this problem, we introduced a curation filter, which is basically an investment readiness, an investability index. It's an investability index, actually. It's a scoring system that tells the entrepreneur pass or fail. It's binary, and if you pass, then you get to meet the investor. If you don't, then you are in an educational loop. So you work on XYZ, deficit that you have in your proposal. The proposal, it's how I see it. So it's, automation and presentation and coaching is one thing. So this we could solve for. If you have the wrong business model, we can maybe depict it and analyze it. But if you have a bad team to execute, we can't help you.
For sure.
For sure. Because at the end of the, so but this is a very very interesting point, Stereos, because with this curation filter, it's a new feature, and then now this is you would pitch your startup to us actually, and then we will get you that investability index. And then if you pass, you get to straight to the investor. And then here we are actually promoting quality, and quality is based on education basically, okay, and on presentation and on the fundamentals of the company. So I think this is how I believe I've answered your questions, Stereos, in this way.
Absolutely, Akram. And you also spoke about the very exciting stuff. And you also spoke about the process of identifying the right investor, right? So we have the readiness process, and then identifying the right investor who is going to be a strategic partner for that company for quite some time in the future, until they may decide to exit one way or another. How would you have some thoughts with regards to how should an entrepreneur approach this task? We understand that there is a lot of automation here, but how should an entrepreneur approach this task in order to make sure that they reach out effectively to investors and actually identifying and communicating with the right investors and confirming a meeting with them?
Look, I mean, this is a very open-ended question. I mean, I'm a bit biased to answer it because we have solved for it. But if there is, I mean, we put aside our solution, how? Yeah, I mean, look, the how is you can't do. I'll start with the most efficient solution out there, and then the most solution out there is to hop on any Tinder for investors. And how it works basically, it's depending on the algorithm accuracy and equity and emotional intelligence. Sometimes it's how they match the attributes of supply and demand basically, and this is conceptually, this algorithm is built on structured data, okay, and there's when there is a match, it's 1. When there is no match, it's 0. So that's how it works, to make it simple. And so this is the most efficient solution out there. Is I hop on a platform, I answer questions, and these questions will be used to match me on the other side of the platform of investors that would have informed their investment thesis statement, which are investment preferences. For example, I invest in fintech, agriculture, oil, XY, these preferences, and that machine does it efficiently, and you will have your short list. So this is the best solution out there. I mean, this is the ideal solution, obviously.
And it's absolutely incredible how by identifying and defining and replying back to all of those, questions, industry, geographic location, and all those things, what you guys do with Instaval is able to automatically kind of match those potential investee companies with their investors, right?
Absolutely, yeah. I mean, yeah. Stelios, you're saying it's great, but I think it's just natural, It's
yeah. Well, you guys are doing a great job developing something that is natural, but making it easy, again,
Yeah,
it's always a
true.
challenge. It's always a challenge. So you make it easy.
True.
And then let's say with COVID-19, with COVID, we have all those challenges again that are affecting the valuation process. And then let's say we have been faced with an unprecedented challenge, which is a global pandemic. Would you be able to share some of your experiences, what you've seen, what you expect, what you've seen as a result of what we have been dealing with during this period?
Yeah, I mean, it's funny enough. I mean, we've done actually a study on that. I mean, I'm not sure if I've shared this with you, but I can pull it out right now, Stelios, and we've done a study on. Can I share my screen, Stelios?
Of course.
Yeah, so it's here. Yeah, I mean, and that was back in the when the the pandemic was there. So basically, in a nutshell, in a nutshell, Stelios, it's the it's the COVID-19 impact on industry valuation. So let me do this now. And it's not any far from. So do you see my screen?
Yes, we do.
But you don't see anything, I guess. Now we see anything?
Yes, we do. COVID-19 impact on industry valuation.
Yeah, exactly. So that was back in March 31st, 2020, last year. So this is to answer your question, technically speaking. So yes, I mean, we've done this job on identifying the top gainers and top losers from the impact, the COVID-19 impact on the industry valuation. So you have, it is it's a no-brainer that education is not being hit, and health tech is doing great. And a no-brainer that real estate and healthcare are taking a hit. And there's another page on that. Yeah, so the least impact, top 5 gainers are least impacted. So yeah, education, health tech, blockchain, cyber, big data. And these were we have the industry multiples by EV to sales and EV to EBIT. So yeah, I mean, that's on the most impacted are marketing, technology, real estate, healthcare. Yeah, so that was a quick sharing of facts and technical and fundamental information. Yeah, obviously COVID-19 has changed a lot of things. I mean, as we saw in this couple of slides. So and there are some industries that will be definitely and ad vitam aeternam impacted. I mean, there are some irreversible changes or corrections that some industries would lose 50% valuation, because it's you want to see each industry as its industry valuation. When we speak about company valuation, or it's industry valuation, and it's the same as total addressable market. It's the valuation of that market. So and the valuation of that market or that industry is fueled by the volumetry of consumers around that market and the long-term value of those consumers. So it is no different from a company. Micro or macro level are quite the same. So yes, aviation, for example, is taking a hit. So we don't need to travel. You're in New York, I'm in Dubai. We're not going for a drink in Soho tonight, for example. And we're good as we are like this, and the top loser in this conversation is the aviation industry, for example.
Well, so, God willing and Corona permitting, we are going to be able to have that drink soon enough.
We will, but not. I'm just saying, not tonight, not tonight. But definitely, definitely. And I love New York. I used to live there actually. So
Either in New York or Dubai, or both.
Oh, Dubai, yeah, inviting you over, definitely, Stelios. Yeah, and actually your project will work just fine here. I mean, one business world, I mean, it reminds me of the World Trade Center here. So.
For sure, and we'll do many stuff together with One Business World and Instaval. Akram, incredible insights, and thank you so much again for your presentation as part of the Leading Entrepreneurs of the World series. Congratulations on all of your success so far with everything that you and your team are doing at InstaVal. You guys are doing an incredible work and supporting the global business community. It's awesome. And we're very excited to continue admiring your growth and expansion. Thank you for your presentation. It's been great. And we look forward to speaking with you again soon.
Thank you, Stelios. Thank you for having me, and looking forward to keep the ball rolling. So yeah, absolutely. Thank you very much. Cheers.
Thank you. Talk to you again soon. Bye-bye.
Bye.